following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and a profitable and a safe trading week given all the volatility action we've seen over the past week. My name is Mark Longo, and I will be your host for this program, and I am joined, as always, by my boon companion, the lovely and talented Don Schlesinger from the Volatility Exchange. Don, how are you doing this fine Thursday afternoon, sir?
Just great. Looking forward to a lovely weekend. We've got some good weather here in the New York area, and nice to be able to get out and get a little sunshine.
And listeners, Don is recording from his palatial estate in upstate New York, and if indeed you do hear any noise in the background, it's because Don's army of manservants has descended upon his home to do some landscaping today, and so you may hear a little bit of chopping and mulching and mowing in the background, but do not be alarmed.
I'm hoping the gardener has moved on to the next house, but if he returns, we'll see.
It's just everyday activity at the Schlesinger estate. All right. With that, you may hear some tinkling and rattling in the background as Don's other manservant brings him his tea during the episode. So stay tuned for that, listeners. All right. And with that, we will roll right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is the portion of the show where we, surprise, as the name implies, review the volatility action we saw over the past week. And since today is Thursday, we will have an abbreviated time frame for today's Volatility Review. But we will kick things off with our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, how was your week in volatility, sir?
Well, I would say that this was the most interesting volatile week that we've had in almost a year, so basically since Japan. And here's why. I love situations where the market isn't doing anything, but volatility is increasing. In fact, the only real place there was volatility was actually in true, price movement volatility was actually in the currency markets. You know, we saw the euro moving around pretty actively. If only there was a product that traded that type of volatility. Oh, wait, there is.
If only.
No, S&P not really moving that much in realized volatility, but really running around when it comes to realized. But until this debt thing gets resolved, the whole market's in a pickle, right? Can't buy treasuries, can't buy stocks. What do you buy? You know, the Swiss franc, I guess, right? And gold. So it's really unique. We're seeing some really cool implied volatility. And I'm looking at some of these plays, and there are some really cheap bets because of screwed up VIX skew that can be made that I really like. So that's kind of what I'm seeing. It's been a week of rising implied volatility this week, if little realized volatility, sans euro currency.
Screwed up VIX skew. Say it ain't so, sir.
I know. Shocker, right?
How could that possibly be?
I know. So.
All right. Thank you for that, sir. And of course, we do cover the broad purview of volatility and volatility products on Volatility Views, and that includes the old Euro and the Euro VolContracts. And Don, what interesting activity did we see out there in the land of Euro VolContracts this past week?
Well, we had our fifth expiration. It took place last Friday. The front month, July 1 vol, or 1 month realized volatility contract, settled at 12.13, so still a little bit higher than historical averages. And it also marks the fifth consecutive contract since we started back in February, where during the life of the expiration cycle, which is anywhere from about 19 to 20 some odd days, there was a movement of the price of the contract in excess of 20%. So we're keeping up with that volatility of volatility itself, and in this particular case, low to high during the life of the July contract. We did actually have slightly greater than 29% move. So these contracts continue to provide ample opportunity for traders. We've started the August, and as some people who follow currency might know, there have been several volatile days already in the euro, such that even with that 12.13 settlement of the previous contract, we're now trading the August at 13.43 settlement from last night, and we're only 3 days into a 20-day expiration cycle for this new August. And those 3 days, of course, will smooth out after a while, but they've provided over 16% volatility for the realized volatility period, which is very early on. So we continue to see lots of volatility in the euro.
Well, that's a good thing to hear, considering it is a volatility product, so a lack of volatility may hurt the activity somewhat. But I know we talked on previous shows about your plans to expand eventually into other products in the equity realm and beyond, but since you are already up and running and established on the CME with the Euro contracts, and the CME has a host of other currency contracts, has there been any talks with the CME about maybe adding a few more underlyings to the mix and a few more currencies perhaps to broaden out their portfolio, so to speak?
Yes, that really is the hope. We had Craig LeVay on Mark Sebastian's seminar or webinar that took place 2 days ago. Perhaps some of our listeners actually participated in that. We had several hundred who signed up, and Craig gave a little introduction to the product, and then Mark gave his very informative webinar that took about an hour or so. And in that, Craig, in fact, discussed the other potential for the pound, the yen, the Australian dollar, the Swiss franc, and basically the other in the suite of FX products that CME has. So there is the very distinct possibility that down the road they will introduce vol contracts on other of their currency pairs.
Speaking of Mark Sebastian, how was that volatility seminar? How did it go?
Getting some good feedback already. Mark did a lovely job, and as I said, presented for almost an hour about currency trading and featuring explanations about implied versus realized volatility, how calculations are done, how the vol contracts work, distinctions between the realized product and the VIX product. So I'm hoping we've already gotten some good feedback that listeners enjoyed, and that they perhaps will now sign up for his more extensive version, where he's actually going to give a 4-week course that will go into much greater detail. So listeners can go to CME or take a look on our site or to the Price Futures Group for further information, or contact Mark directly at optionpit.com.
And, of course, this is just the first of many upcoming webinars and events that listeners can look forward to from Volex, and so when we have more information about the next event, we'll be sure to pass it along to you. But I know you guys at Volex have some interesting things planned down the road, so we'll keep our eyes peeled for that. And with that, we will close out our volatility review for this week and roll into a much delayed and long overdue listener mail segment.
Listener mail. Listeners right in.
Mail's in.
Mailbox.
And welcome to the old listener mail segment. This is where we answer your questions, whether it's via email or via Twitter or via Facebook or quite commonly the Options Insider forums, where we receive quite a few questions on a regular basis. And Don and I have been very busy with a variety of guests and other projects lately, so we haven't had a chance to delve into the mailbag, so it's nice to have a chance to open it up again. And let me just plop it on my desk here, and it's a big mailbag this week, and it's smelling a little musty. Maybe we should change out this bag, Don. What do you think? But we're going to start things off. I think we'll ease into it a little bit. And here's a question we received on our Options Insider forum. It's from someone who uses the handle Stock Surfer. I like that. He surfs through the waves of volatility, I suppose. And it's a common refrain we see here on the Options Insider, but one we haven't particularly addressed on Volatility Views, so it might be a good time to dive into this one. And the title of his post is Option Price Dropped as the Stock Price Went Up. And I think a lot of our keen-eared listeners will know where this question is going. But he writes, I am fairly new to options trading, and I'm a bit confused about my last play. I am in a July call option, and in the last 2 days, my option went from 35 cents to 30 cents per contract, while the stock price went from $81.51 all the way up to $84.68. I understand time decay, but this doesn't seem to fit that mold. Could someone please help me understand what caused this and how I can avoid this in the future? Thanks in advance. And Don did dive in and answer this one, but this is indeed a common refrain. Like I said, we hear on the Options Insider quite a bit. I've addressed this on numerous topics and articles and even webinars. I've done on this in the past. In fact, I did a very popular webinar, I believe a year or so ago, called The Top 5 Mistakes of Options Traders, and one of the ones I detailed in extensive detail was this type of skew coming in back to bite you. We see this question quite a bit, and this happens in a number of different scenarios. One of the most common we see when people have this happen to them is they are usually trading in and around earnings. They'll come in right before a major event, like an earnings announcement or something else that is created a great deal of implied volatility in the underlying. They will buy an upside. This guy doesn't say whether these are at the money, near at the money, out of the money. I'm assuming these are out of the money calls, that 30-cent contract like that probably. And that's usually where this type of trade and this type of event occurs, is in the out of the money upside call wing. And so they'll buy an upside call trying to speculate on some dramatic movement in the earnings event, or whatever the anticipated event is happens. The underlying moves somewhat, but the implied volatility that had built up around that event just deflates like a balloon. And as this trader learned, and as many traders learn, you need a significant movement in the underlying to offset that implosion, that popping of that volatility balloon. In this case, doesn't seem like he had enough movement in the underlying. And in other words, he dramatically overpaid for his volatility on whatever strike he was trading. And this is, of course, a fundamental property of option skew, which we have addressed a little bit in the past on this show, which is, of course, as you move up that skew curve, the implied volatility in that call wing or in the upside of that skew is going to decrease. So if you just follow the track of that skew, the options should indeed decrease in volatility. It shouldn't be this dramatic. You shouldn't actually, usually you will not lose money. The calls will work out for you. But in some of these more dramatic scenarios like earnings and perhaps other situations where perhaps this is the name where there was a dramatic amount of upside call buying when he bought his options, and so the volatility on that strike and the nearby strikes in the call wing was indeed inflated, and then of course the normal trading activity happened and the rallying of the stock happened, and that combined to deflate the volatility on that strike. Whatever scenario caused it, this is the classic skew / volatility deflation around an event that combined to bite this trader and has bit many traders in the past. So the way to avoid this primarily is to watch your volatility levels. If you're buying a volatility level that is enormously inflated, be aware of that and be aware that it will require a significant movement in the underlying in order for that to pay off. And Don, you responded to this question as well, so I'll let you dive in as well. But I imagine you have a similar take on this?
Well, everything that you've said is absolutely true, and I couldn't say it any better. I'd add 1 or 2 points.
You can always say something better, Don. Go ahead. Don't be modest, sir.
Just reinforce the issue, but to also kind of compare and contrast. Obviously, this was a call option. Obviously, the stock went up, and as you correctly pointed out, the skew goes from upper left to lower right, and so as you're going higher on the underlying price, the implied volatilities are going down. But consider someone who might have posed a similar question or simply held a put instead of a call might have turned out somewhat differently, because there, as your stock drops, which is what you want if you own a put, you actually become the beneficiary not only of the delta and the gamma, that is the price movement of the underlying, but then the skew actually turns around and works in your favor. As the stock drops, you go to a lower level and move down to the left on the horizontal axis, and then that corresponds to a higher implied volatility as you go further out of the money. So it's kind of a double-edged sword, and sometimes you benefit from it, as I've just described. Other times you kind of fall victim to it. The second point that I wanted to make was he didn't say where in the expiration cycle he was or how many days there were to go. He did comment briefly that he understands theta or time decay, but you also have to kind of be careful with time decay because it's not a linear function. And so a day's worth of time decay is not the same towards the end of the cycle as it is in the middle or in the beginning. And of course, depending on whether it's an at-the-money option or an out-of-the-money option, the curves are different for the either accelerated time decay or perhaps vice versa. So that enters into the equation as well. It always behooves people when they buy options or they own options to know where in the expiration cycle and where along the decay curve they're living at the moment. Because especially with at-the-money options, we know that the rule of thumb is that they start off decaying fairly slowly, but then they have that accelerated kind of like falling off a cliff type of profile as you get closer to the expiration. So you need to keep that in mind as well as you're looking for the effect of getting some gamma and delta and hoping to make money, but constantly fighting the time decay that's always working against you.
That's true. He didn't specifically mention what he was trading aside from the fact that it was a July call option. So it could have been a weekly, it could have been a very near term, close to expiration July call. And it looks like he bought a very out of the money call. So he could have, like you said, he could have just bought a very out of the money call. And even though the underlying moved his way, it just didn't move enough to offset all the decay that was coming in the last few weeks of an option's lifespan. As we all know, that's when the bulk of your time decay occurs, and if you're long options, you need to take that into account. As Don likes to say, your options die a little every day, and they die a lot more towards the end. So
that's exactly right. And if I were to guess along with you, I'd say that's exactly what happened. There was like a double whammy here, that he got hit with a considerable amount of time decay. The skew did not work in his favor as the stock worked higher. And so the combination of those two events or those two phenomena simply overwhelmed what he should have gotten from the pure price movement of moving up.
Yeah, all too often we see new options traders coming into the markets and they learn a little bit about options and the Greeks, and they become very enamored with delta. and they trade around delta almost to the detriment of all the other Greeks, as in this case, he was very cognizant of delta and he had some directional play in mind, but he wasn't perhaps as cognizant of volatility and time decay and the impacts those would have on his options price and to his detriment.
And it just kind of points out, Mark, as everybody knows, but it's worth mentioning that trading options is simply a little bit for the more sophisticated and a little bit trickier than simply trading straight line products like futures and like stock, where obviously there's still a skill involved, if you will, in picking the stock and in making a directional forecast or play, but there you're involved purely with direction. Is it going to go up? Do I own it? Will I make money? Is it going to go down? Will I lose money? And such discussions as skew and implied volatility and time decay simply just don't enter into the equation. So again, just a caveat for those who are venturing into the world of options for the first time. There are just other things to consider than simply directional movement of the underlying, and this is a case in point.
Yes, and Stock Surfer, just to close out, if you want to avoid this in future trading scenarios, then always be cognizant of your volatility levels. If you're buying an absurdly high triple-digit volatility level on a particular strike, you can pretty much guarantee that is probably not going to pay off unless there is a very dramatic movement in the underlying. And then secondly, if you do want to avoid this again in the future, then perhaps migrate some of your trading activity closer to the at-the-money. Perhaps go in the money a little bit. Don't be afraid to buy options with a little more meat on the bones than obviously they're more expensive, so that premium is a little bit off-putting to new options traders, but people who've been around a little bit know that when you're going long premium, it does help to have an option with a little bit more intrinsic value, a little bit more inherent value to it, so these types of things are a little bit more difficult to happen to you, where your entire option is composed of extrinsic value, which is nothing more than volatility premium and time premium and interest, and that obviously can go to zero in a heartbeat much faster than if you had an in-the-money or at-the-money option with a little bit more meat on the bones. So don't be afraid to migrate your liquidity, and by all means, keep an eye on your volatility levels. And now we're going to switch gears to another question from our Options Insider forum. This one from an old hat we've had on the forum for a long time. His handle is Options Guy, and his title of his post is Seller's Premium in Options. And he writes, I'm intrigued by Don's notion of a seller's premium in options. It's not something I've encountered before in all the literature I've read about options and options trading. I wonder if he could delve into that a little more, since I'm not sure if I understand and or agree with the concept. Am I correct in interpreting that you believe options market makers charge about a 4% premium when they sell options? Is that the gist of it? If so, how did you arrive at that percentage? As I said before, I've never heard anyone suggest or attempt to suggest anything like this before. And Don, since this is addressed to you, I will let you take the first swing, sir.
Well, the first point is that it's not so much options market makers as if the only way that you can buy an option is from a market maker. Market makers are there, of course, to facilitate trading and make two-sided markets so that you have liquidity and that so you have the ability for buyers and sellers to meet in the marketplace. But just as often, if you look at bids and offers, you may be buying an option that somebody is selling to you, not from a market maker, but from any counterparty whatsoever who is out there. And so we're not going to pin this risk premium, as it's called in the literature, squarely on the back of the market makers. We need to consider sellers of options as a group, and market makers simply being a subset of buyers and sellers and market participants in general. But the phenomenon that we're talking about is one that we've mentioned several times on the show before. If I were to tell you that the average long-term volatility of any asset, let's take the S&P 500, was about 16%, and that was a historical calculation, And I said to you, let's forecast where volatility will be for the next month, and you think that 16% is about right. The question then comes up, when someone goes to sell an option, should he or she be content for pricing that option and selling it at an implied volatility of that same 16%? And the answer quite simply is no. And the reason is fairly straightforward. What can we expect for a range of volatilities over the next month? Well, it could be very, very low, and the 16% might go as low as single digits, 8 or 9 or 10, in which case a buyer would lose, 5, 6 points. The seller might pick that up. But there's a tremendous asymmetry, because what could that 16% come to on the upside? Well, think back to the October 87 crash, where implieds went to triple digits. Think back to the end of 2008 and the Lehman crisis, where implieds were in the 80s, if I'm not mistaken. So a seller takes a look at that and says, darned if I'm going to let these options go at 16 volatility just because that's a historical long-term mean. I've got to demand from the buyers some kind of premium here that's going to give me a little bit of a cushion, because I'm the one who's on the hook if the world comes to an end. I'm the one who's going to get my head handed to me if I am short volatility or short Vega and it suddenly explodes to the upside. And so we continually see, and of course it's not an ironclad rule, that 4% is a long-term historical risk premium for equity, but it jumps around itself. There are times when implieds are the same as what realized manifests itself. There are times when it actually inverts and it's a little bit lower. And of course, there are times when the risk premium is 5, 6, 7%. So what we're talking about is not any kind of a mathematical law, but simply a long-term trend, an average, which settles in at about 3 to 4%, that is being asked for by the sellers to compensate them for the open-ended risk that they take.
I think sometimes this poster in particular may also be confusing general risk premium with seller's premium and a few other things. Obviously, there's that general risk premium that's built into all assets. For anyone who needs to make a market consistently is certainly not going to trade it at the fair market value. They need to have a little bit of edge to offset the risk that they're taking, a little bit of spread, and so that factors into a lot of this as well. Like Don says, if the historical average of an asset is 10%, they're probably going to, put the bid at 8 and put the offer at 12 or somewhere in that range. They're certainly not going to trade it in and around 10%, because it simply wouldn't be a long-term viable prospect for any sort of liquidity provider if they traded in that manner. And that being said, Don, I'm sure you might have some good suggestions for this poster as well, in terms of maybe some further reading he might want to do to further familiarize himself with the concept of risk premium, and perhaps if you have any specific papers that delve into your concept or what you mentioned of the seller's premium, or that implied 4% or that 4% edge or inflation that there is in implied versus realized. And by all means, I think our listener would like to read that as well.
I think that there are several academic papers. I don't have my finger on them right now, but I will point you in the right direction. On our website, volx.us, so volx.us, we have a section in the reference pull-down menu that's called the Volatility Library. And there is an extensive array of academic papers, both on implied, historical, all kinds of studies on volatility. And perhaps between now and our next program, I'll actually put my finger on some that specifically discuss this, but you can tell by the titles and the abstracts of many of them exactly what the main topic is. And this is something that comes up over and over again. So that's a really nice reference section for somebody to go to who's interested in some of the academic papers and some of the more scholarly aspects to options trading. I might mention that this same phenomenon manifests itself in swaps trading, in variance and vol swaps, and to a certain extent, we feel will be the case in the pricing of our realized volatility contracts as well. And that is, if you go in and you go to the over-the-counter swaps market and you say, I would like to own realized volatility for the next 3 months. I understand that in the swaps market, unlike the VIX products, virtually all swaps contracts that trade over the counter use the realized volatility concept. There's a formula, standard deviation. It's written out in the contract that the two counterparties sign. They tell you exactly how they're going to calculate volatility for the next 3 months. And that's the same formula that we use at the Volatility Exchange for our VolContract futures. In any event, you may have a certain level in mind. You may think volatility is going to be on the rise for the next 3 months, and you get a certain strike price, a reference point at which this vol swap is going to be struck. Well, mathematically, the pricing for that contract turns out to be virtually all the time extremely close to the at-the-money implied volatility of puts and calls, so straddle, of options with the same maturity as the vol swap, so that the dealer is probably going to quote to me as a strike price for the vol swap, perhaps a bid and offer around this number, but something that's very close to what the 3-month at-the-money straddle implied volatility is for the options that correspond to the particular underlying. And so then to take that one step further, suppose you're now buying a realized volatility contract from the seller of that particular underlying volatility. They're going to follow the same principle. They basically have this listed product that we now have on an exchange, transparent listed product on realized volatility, and it really does have to trade very much in line at the beginning before we start calculating the actual volatility with the vol swap market, because there would be an arbitrage there. We're using the same formula. So there should be similar pricing where once again you will have that risk premium that the seller is going to build in with respect to his reference for where he thinks realized or actual volatility is going to be.
Well, thank you for that summation there, Don. I figured you'd have a good answer in store for you, since that is one of your pet topics, the risk premium, the seller's premium that is built into options pricing.
You know what, Mark? I put out one final thing because I always try to be responsible. Lest listeners or traders or anyone else think that you just step right up, sell this, collect your 4%, and that it's like stealing. Understand that it's like this for a reason, and that you can sell options, you can sell our vol contracts, you can sell anything in which this premium manifests itself. But understand that people did that in front of the October 87 crash. People did that in front of the December 2008 meltdown. So that this is not necessarily for the faint of heart. And this is something where you need deep pockets. You need a bankroll that's adequately capitalized. And obviously, this is not just something automatic where you step up to the bank with a withdrawal slip and think that you're going to collect your money. So there's tremendous amount of fluctuation. There's risk. And it's something where long-term, adequately capitalized, there's room for profit and for an edge, but it doesn't always come according to any schedule. It doesn't always come regularly, and you have to be prepared for drawdowns. You have to be prepared for times when you're going to lose right out of the bat, and it's going to take you several months to recover and to make it up. So listeners should understand that the principle mathematically is a sound one, but that doesn't mean that it's a foolproof way of just backing up the truck and making money.
Well said, sir. And that's going to do it for the old listener mailbag this week. But don't worry, if you're writing in or have written in, we'll have more mailbag segments on upcoming shows, and we'll be sure to delve into more of your questions and comments at that time. And now we're going to roll right into our crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is the portion of the show where we all speculate wildly about what is coming up in terms of volatility and volatility trading. And we'll kick things off with our good friend Mark Sebastian, the Seabass, a.k.a. the Greasy Meatball from OptionPit.com. And Don, you'll have to ask him someday, maybe at your next webinar, how he got that nickname.
Okay.
Mr. Seabass, Mr. Greasy Meatball, what is on your crystal ball in terms of volatility?
I see no deal this weekend. No deal. No deal on over the weekend. This gets released on Monday, doesn't it?
It does, but you can still prognosticate, and we'll know if you're right or wrong.
All right. So right now, there's probably no deal done. And if we don't have a deal done over the weekend, we're at a point where any kind of mediocre economic news is going to send us south. I think we've got a real good shot at realized volatility levels popping, and the VIX. And if the VIX is going to make it to 30, this is going to be the event that sends it there. And so I see some real opportunities in vol really kind of peaking. So that's kind of my thoughts right now. Now, does that mean that I'm basically just holding off everything, waiting for the VIX to explode? No. At levels here, I've started to tip my toe in the water on getting shorts and premium, but I'm not going whole hog until we break 25. So, that's just me. What do you think, Mark?
Yeah, I agree. We haven't been fully enticed yet into diving into any crazy short premium positions, precisely for the same reasons that I think there's a little more downturn to go, a little more vol pop to go, and there will be higher levels. For example, we've been dancing in and around Ford here, and I think Ford has higher to go on the vol charts and lower to go on the price charts, so we are acting accordingly there. And of course, there's a lot of earnings coming out this week. For listeners, we're recording this actually these segments on a Friday morning, and the Citigroup earnings just came out, which were apparently a non-event, hasn't moved the market at all. But there are a lot of other earnings to come out, and of course there is that potential weekend risk. I don't know if you want to go short into the weekend, despite the fact that it may or may not happen. There is that additional weekend risk this weekend with all the things happening there in Washington. You don't want some negative development to happen over the weekend, and that, of course, to come back to bite you if you are getting short, and the VIX to pop to 25 or 30 on the opening print on Monday, and you went into the weekend short. So, this is a time to be cautious, I think, and definitely pick your poison, pick your battles, pick your vol levels if you're going to be on the short side. And if you're going to be on the long premium side, be savvy as well, because we are getting a little bit pricey, and some of these names have had a little bit of a vol pop now. You don't necessarily...
Yeah, well, interesting trade I was looking at was long VIX calls, short VXX calls, and, some weird VIX straddles. So I thought there were some interesting things out there. I think that Euro currency contract looks real interesting right now, so... that would be one other thing. And Mark agrees with me.
Our co-host of the week, good old Mark Seabass Jr. All right, and thank you for that, sir. And Don, speaking of volatility and all things vol, what is on your crystal ball in terms of Euro Vol, given that you are indeed the preeminent expert in Euro and Euro Vol trading?
Well, far from it, but I'll venture a guess. We always like to say to our listeners that we never know whether volatility is going up or down, but in lieu of always having an opinion, you can do worse than look at historical levels, compare where you are now to those levels, and then act accordingly. We actually are seeing levels of Eurovol, which historically put these numbers that we see right now in about the upper 10%, which is to say that 90% of the time, 1 month volatility in the euro historically has been lower than what it is at the moment. So you can get that kind of information from our volatility cones on the website or simply by doing your own research. So volatility being a mean reversion kind of asset or instrument, you might do worse than to think that the current level of 1343 with the first 3 days of our front month at 1609, if you put a gun to my head, I say we go lower rather than higher.
Well, thank you for that, Don. And that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. I want to thank both Don and Mark Sebastian for joining me on the program today. And Don, every week we discuss something interesting, something new, something fun that's coming up on the old volex.us website. And as I always say, I'm continually impressed as someone who runs a website himself at the level of new features and new additions and new content that you guys are able to put out on a regular basis with such a small and dedicated team. So that being said, is there anything interesting or fun you want to make our listeners aware of that's coming up on volex.us?
Yes, actually, it's a repeat from last week because, if you will, a promise is a promise, and I mentioned something last week that I had hoped would be live by today. We're a little bit of a short week, and it isn't yet, but I'm almost certain that it will be by our next show, and that is these charting capabilities where we look at past levels of volatility, so historical, and we superimpose forward predictions from Robert Engel at the Volatility Institute and at VLab at NYU Stern School of Business. And we kind of, if you will, see how well they're doing with their Garch modeling and their forecasting by being able to lag the one with respect to the other so that they cover exactly the same time period. And then take a look at these graphs. I've seen the workups, and they're really very impressive. We just haven't quite gotten out all the kinks and gotten them on the site yet, but I'm virtually certain that will be forthcoming in the week to come.
Sounds interesting as usual. And listeners, of course, you did miss the volatility webinar this week, but I'm sure you can. Is that available for repeated downloads on volex.us, Don?
I believe that we are putting it up there. We were just talking about that the other day as well. And so I think you're going to be able to go to the website and actually be able to download and replay. Also can be able to contact Mark at theoptionpit.com. And I believe that he said he would make the slides available if somebody would actually like to have the actual presentation on a computer or print them out as hard copy.
Fantastic. And before we go, I would also like to plug to our Volatility Views audience. If you are in Chicago or going to be in the Chicago area next week, on July 21st, we are having our first ever live recording session of one of our other Options Insider Radio Network shows, the popular Option Block program. We will be recording it on July 21st from 3:30 to 6:30 p.m. at Elephant and Castle right here in Chicago at 111 West Adams. Swing by. If you come in the beginning, come in the end, come in the middle, come anytime you want. We have activities going throughout the entire session there. We'll be giving away prizes. We'll have some fun special guests. We'll answer a lot of questions, and we'll do our traditional option block format. We'll talk about what's trading. We'll talk about unusual activity. We'll do some educational hits. We'll do some upcoming tidbits and a lot of other fun stuff that we do on the option block. Of course, you mentioned Mark Sebastian. He is on that program. He will be at the event, as well as the guys from Know Your Options and a bunch of guys from Options Express, as well as a number of special guests and a large audience. So if you are indeed available and in Chicago next week on July 21st, we would love to see you right there at Elephant and Castle. Don, I would extend an invitation to you, but I know you are busy off there with your track meets in upstate New York, sir.
Well, I would be delighted to listen, and if I can catch it at a later date, it sounds like something that we don't want to miss.
Yeah, this is kind of a trial run for us. We're kicking the tires, so to speak. But I believe, given the feedback we're receiving so far and people who are signing up, it should be a pretty interesting and pretty fun and pretty popular event. And if this goes well, we plan to have many more of these with our other programs, including Volatility Views, down the road. So maybe we can plan a live Volatility Views. And I have a feeling somehow Mark Sebastian will sneak his way onto that one as well. That guy he claws his way into everything I do, it seems. He's a sneaky little character, but a fun one.
Sounds great.
All right, Don, thanks again for coming on the show. And I also want to thank all of our listeners out there who download and stream and subscribe to this show on a regular basis and help propel us into the top 20 there on iTunes for business and investing. That was indeed a big feather in our cap for the old Options Insider Radio Network. So thanks again for listening to the show, and we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.